In today's video, we're going to discuss the top 5 REITs that I'm buying in 2025 to combine with our Yieldmax dividends. Yieldmax helps us earn over $500,000 per year in dividends, as you can see below. And we're outperforming all of the indexes with Yieldmax and margin. We're at 0.66 for the year. The S&P is down 2%, the Nasdaq's down 3%, the Dow's down 2%, and the Russell's down about 2%. We're also down 17,000 on Friday, but that's only 1%. As you can see above, that also beat the indexes. So we're living financially free out of our brokerage accounts using Yieldmax, margin, and some other dividend-paying funds. If you need help doing the same, email me for my e-guides at aikandtodd48@gmail.com. My margin debt is around $600,000 right now, as you can see, but our dividends of over $500,000 will pay that back in around 1 year. And I've also been adding to my margin debt recently because of these unique opportunities that I'm seeing arise in the market. I've been pounding the table on the fact that 7 out of the 10 sectors in the S&P look cheap, and real estate is one of those key 10 sectors. So I've been adding to my margin once again because I see unique opportunities presenting themselves in the real estate sector. Not only do real estate stocks have really attractive charts right now and attractive valuations, but they also help offset yield max decay. They help offset weakness on down days with tech because a lot of times tech moves inverse to real estate and energy. And also these real estate stocks or REITs are helping to cover my margin interest. My margin interest is around 5% because I've negotiated it down twice. Many of my clients who bought my e-guides did the same thing. When you buy my e-guides, you get my phone number for life. So text me whenever you need that script to negotiate your rates down, and I'll send that to you whenever you're ready. We're getting more rate cuts in 2025. I know the rates of those cuts might be less than expected, but we're still going to see a Fed funds rate of around 3% in 2025. So to me, that's still historically low for an investment backdrop. All right. You need rates to be around 5% or lower if you want to sustain bull markets. So I think interest rates are already historically low and they're going lower in 2025. Okay. So first up, we have SL Green Realty. Okay. SLG ticker symbol. They own skyscrapers. Okay. So a lot of people weren't liking skyscrapers and office buildings because they thought that the work from home trend was here to stay. But Jamie Dimon proved the other day that work from home is not here to stay. Okay, he wants to bring his workers back into the office. And I know many other corporations are trying to open new office spaces in the most busy cities in the country, okay, including New York. So that's going to benefit SLG. And with interest rates falling, that's also going to help them. But the other reason why I want to own SLG is because it's just a high flyer, okay? If you're trying to get exposure to real estate, this is one of the biggest movers in the real estate space. Look at what it did earlier in its lifetime, okay? From 2004 to 2008, it went from 50 to 150. So this thing can really move. But right now, it's at resistance of around 75, okay? Let this come in some before you add this into the portfolio. I have other real estate stocks that I think are cheaper and much more attractive to buy right now. I just cut SLG in half, as a matter of fact. But again, if you're going to be buying real estate, this still has a long way to go before it's at its old highs, and it's a high flyer, okay? So it gives you that high octane in your portfolio that you're accustomed to with Yieldmax funds. And it gives you a 4.79% dividend, okay? Paid monthly, all right? So that's why I really like SLG. It's a monthly REIT payer. It's still higher than most dividend-paying stocks in the S&P. Just keep in mind with real estate stocks that they are a small part of the indexes, okay? So keep them small in your portfolio. But the low maintenance for real estate funds are something that you have to appreciate compared to Yieldmax. SLG is 30% maintenance, whereas something like MSFO is 50% maintenance, all right? Even though Microsoft is a much better company than SLG, it's still higher maintenance. I don't know why E-Trade has Yieldmax at 50% maintenance when something like Microsoft is a much better company and a much safer company, in my opinion, than SLG. But nonetheless, you have to watch your maintenance when you're investing, especially with margin. Again, with real estate stocks, you get them with low maintenance, okay? They preserve a lot of your equity as a result. If you need help understanding maintenance, that's in my Volume 3 e-guide. Maintenance is the whole key to what I do at my channel because for every $1 you put in your account, you get $4 of purchasing power. Everyone is granted this purchasing power to them in their brokerage accounts. I'm just using a small amount of that purchasing power to get ahead, and then my dividends of over $500,000 per year, again, will pay back my debt in around 1 year. I'm only growing my debt to the levels that you're seeing right now because I see so many other opportunities in the market, including with real estate. So I've been buying more real estate stocks, and they're barely budging my available withdrawal, okay, because they're such low maintenance. They're 30% maintenance, and therefore I can withstand withstand over 20% corrections in the market without seeing a margin call, and I can still pay my bills in the process, okay? All of my bills are automated out of my E-Trade account. I have an E-Trade checking card. I can buy with it whatever I want, cars, clothes, shoes, whatever I want with my E-Trade checking card. It just adds to my margin debt at the end of the month, and then my dividends just pay it back at the end of the month. But the whole key to doing that is, again, low maintenance. So beware of maintenance, and once again, if you need help understanding maintenance, that's in my Volume 3 e-guide. Okay, next up we have O. O has a 6% dividend, so it's very competitive with real estate stocks. It's higher than the S&P on average. And look at this chart. It was at 65 and now it's at 52. And if you zoom in on a chart of O, you'll see something even more noteworthy, okay? If you zoom in on this chart of O, you'll see, yes, we've had a steep pullback from 65 to 52, but on a max time frame, we're on the 200-day moving average with O. All right, so O is the cream of the crop when it comes to investing with REITs. O has a cult-like following because of its triple net leasing, which means that all of the costs are covered with the tenant, okay? So the tenant has to pay the rent and pay all the costs. So I love REITs that have triple net leasing because the risks are mitigated with those REITs. And again, O here is on the 200-day moving average. So it has a 6% dividend, which is very competitive with other REITs that you're familiar with, and it's covering our margin interest and then some. We're actually owning O at a profit thanks to my margin and the arbitrage opportunity that we're exploiting there. If you're a trader, put your stop losses below the 200-day moving average, but I'm not a trader. I like to live and die with the indexes, and the dividends just cash flow my losses over time with O as long as we collect our dividends. But at this 200-day moving average, we can also get some capital gains appreciation, okay? Again, the stock was formerly at 80. Now, I don't care about capital gains appreciation because all I want are dividends, because after all, that's what bankers accept for loans, okay? So if you want to qualify to banks for loans and truly live the FIRE lifestyle, you have to have dividends, not capital gains. So O's dividends aren't really going to help me qualify for many loans. Yieldmax, Defiance, and Cornerstone do the major legwork for that, but O can give us a small amount of income which pays back our margin interest, and then I see a capital gains opportunity arising here on this chart. I'm showing you O right on the 200-day moving average, so it looks like we almost have 1 or 2 points down and 30 points up from here. So it's a good risk reward scenario if you use a stop loss. But again, if you're just going by the dividend cash flow model, then if we hold O for long enough, we're going to cash flow our investment regardless. All right, how about Prologis, PLD? Prologis is also on the 100-day moving average, and it's at critical support. It was at 175, now it's down to 100. Prologis is a REIT that does warehouses, okay? So if you're into the e-commerce boom and you think that Amazon's taking over the world, Prologis is one of the best ways to go for that, okay? It's considerably off its one-year highs. It was at 130, now it's at 100. But again, formerly it was at 175. So we have extreme upside with these real estate stocks, it's looking like. With the support areas that we're at with these real estate stocks, it looks like downside is minimal and the upside is substantial. But again, use stop losses if you're a trader. And in my case, again, I'm just going to let the dividends cash flow all losses. PLD is also a top weighted REIT in VNQ. So if you're going to buy VNQ and you want real estate exposure to all of those REIT stocks, Prologis is one of the top weighted stocks in VNQ. So instead of buying VNQ, you can just buy some of the top weighted like PLD and O. All right, number 4, we have CCI or Crown Castle. They do cell phone towers, okay? Look at how much this stock is off the highs. It was at 120, now it's at 85, and it has a 7% dividend. So these dividends are starting to rise significantly as the stock price falls, and it looks like this downtrend is pretty solid, okay, for real estate stocks. But look, we're approaching support here as well in CCI. In 2023, we're at around 85, and we're back at those 2023 structural lows. And on a max time frame, you can see here that we're right around the 200-day moving average, okay? So we've broken the 200-day moving average just slightly here, but as you can see in 2022 that held, and in 2023, so there's a good chance that we could hold this 200-day moving average again in Crown Castle. And again, if you're a long-term investor, this is where you want to start nibbling at, okay? If you're a trader, you want to buy here and put your stop loss below. But if you're a long-term investor, you want to start buying in positions, okay? You want to buy CCI here, and you want a dollar cost average on any further dips. But again, keep real estate exposure small in your portfolio because real estate exposure is small in the indexes. We live and die by the indexes here at this channel. That's how we get our outperformance. That's also how we're down less than the indexes on down days, because we go with the indexes, and a lot of times we pick indexes that are less volatile, like Cornerstone and Defiance. Cornerstone, for those of you who don't know, is a 4-star fund, and it moves upward left to right on its 10-year chart at Morningstar. But on a chart at E-Trade, you'll see Cornerstone move sideways to down. That's because you have to play it properly around its rights offerings. Please factor back in dividends, drips, and rights offerings in Cornerstone to again get the total return chart that you're seeing in Morningstar. So on a 1-year chart, Cornerstone outperformed everything, and on Friday it was down only 0.17%. That's how we outperformed the indexes on Friday. So again, we have these index funds that go up on up days but are down less on down days. Cornerstone, Defiance, these help us outperform the indexes on down days because they're less volatile, okay? Cornerstone also gives you a 21% dividend that it drips down at the NAV for 32% gains every month. So we're getting a 21% yield in Cornerstone for the year, and we're getting 32% gains approximately every month on top of those 21% dividends. And we get the premiums in Cornerstone, okay? So we get 20% premiums average per year in Cornerstone, we get 20% dividends per year in Cornerstone, and then we get that special NAV drip ability, okay? That's how we outperform the markets in 2022, because the Cornerstone NAV drip allows you to drip at the bottom, okay, which allows you to buy the indexes at the bottom. And then when the indexes turn around, you make a lot of money on the upside, okay? Just remember to play Cornerstone properly, again, around its rights offerings. Many closed-end funds have rights offerings. If you need help playing Cornerstone, that's in my Volume 4 e-guide. When you buy my e-guide, you get my phone number for life, yes, and you get access to this Discord chat room for life, where we alert you of the Cornerstone rights offering announcement. We have over 1,500 members now in the Discord chat room pursuing the FIRE lifestyle. So if you ever have questions about your brokerage account that I can't answer, someone here in Discord can most likely answer for you. Not every brokerage account is the same. Not every broker has the special drip for Cornerstone, for example. Also, there are many brokers who have lower maintenance than E-Trade, okay? Like Fidelity, Interactive Brokers, Robinhood. But Robinhood doesn't have Cornerstone, and Interactive Brokers doesn't have the special drip for Cornerstone. So please be aware of that. All right, last but not least, we have RFI, Cohen & Steers. This is a closed-end fund like Cornerstone that specializes in REITs. All right, so it has an 8% dividend, and it's substantially off its highs. It was at 13, now it's at 11. So you have approximately 20% upside with an 8% dividend, and it has all of your favorite REITs in it. So you can go with the individual REITs that I've listed in this video, or you can go with RFI. I go with both. I put most of my money in RFI, and then I sprinkle my money into those REIT stocks that I showed you in this video. And then of course I put the bulk of my money in Cornerstone, okay? I only keep a few $1,000s in RFI. Again, the bulk of my money is in Cornerstone because you don't want to have too much closed-end fund exposure, okay? All closed-end funds can fall at the same time. Look at what closed-end funds did in 2023. Again, they all fell at the same time. So you don't want to have too much closed-end fund exposure, and this only has an 8% dividend. Why not go with Cornerstone that has a 21% dividend? But real estate is underrepresented in the indexes. So if you want to get real estate exposure and take advantage of these cheap prices, you can't just buy the indexes, in my opinion, because you're not going to see the full effect. All right, so I'm loving the low maintenance of these REITs because they're not taking up any of my available for withdrawal. They're only taking up 30% of my available for withdrawal. That means I can withstand over 20% corrections at all times and still pay my bills out of my account. Should we have over a 20% correction overnight, well, then I have my put options on just in case we have that kind of crash. Everyone says that the great reset's coming in 2025. I don't believe any of them, but should that happen, should we have some meltdown overnight, well, then we have our put options, which would make us more money than we lost in the event of that crash. Our put options were up 50% on Friday alone, and during the month of August in 2024, when we had that 15% correction, our put options were up almost 2,000%. Imagine a 20% crash in one night. Our options would be up thousands of percent, over 4,000%, and that would make us over $1 million in our put options, and all I'm really risking with my put options is $100 as insurance, okay? And I expect to lose that money every month, but that helps me sleep at night and insure my portfolio in the process. If you need help hedging your portfolio with put options in the event of a crash like I do, that's in my Volume 5 e-guide. All right, so we're living financially free out of our brokerage accounts, outperforming all of the indexes with Yieldmax, Margin, Defiance, Cornerstone, and Roundhill funds. Now we're adding real estate stocks into the mix. We're outperforming all of the indexes. We're up 0.66%, and you can do this too. If you need help doing the same, email me for my e-guides at akintodd48@gmail.com. When you buy my e-guides, you get free access to Discord for life, and you get my phone number for life, so keep that in mind. All right, if you like the video, please click like or subscribe, and I'll talk to you soon, everyone. Thanks.